What's going on? Today's video is going to be a little bit spicy, a little bit hot take. I know a lot of people don't like this specific issuer, this specific fund, but we're still talk about it because we are a cover call ETF channel. We are a income investing channel. So we talk about everything cover call ETFs, income investing, financial, everything, all of it, anything and everything. I mean, even things that don't relate to it, because you know what? Everything relates to income, right? Alright, so welcome to the channel. I am the cover call guy. For those who are new, my goal here is to create $120,000 in annual passive income. Currently holding 6 cover call ETFs. Right now, my projected annual dividend slash distribution income is about 70 grand a year. That is about 5.8k a month, 1.3k a week, and $191 per day, $7.99 per hour. Alright, legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, at the end of the day, I am just some random clown you found on YouTube, and I could be completely wrong. All right, now with that out the way, let's get started on today's video. We're going to be talking about the big D. Maybe some of you guys like it. Maybe some of you guys don't want it. All right. The big D, we're going to be doing a teardown of the YieldMax DDDD ETF, right? So this is my brutal deep dive teardown of the YieldMax US stock target double distribution ETF of SCHD. Again, I'm going to be calling this one the big D. All right, now that the prospectus has been released, the stock is active, right? We have more information. I had to do a round 2. As you know, I did a previous video, and it was pure assumption just based on what YieldMax typically their products, they kind of push out. So again, guys, I'm gonna be calling this the big D. Maybe some of you like it, maybe some of you guys won't. All right, I'm gonna be ripping apart the prospectus and showing you exactly how it works. Again, disclaimer: I could have read the wrong information, and I might be wrong. So give this with a grain of salt. Okay, let's get started. All right, so let's look at the big myth here. All right, so is it in a synthetic casino? Well, I'm assuming everybody assumes these YieldMax funds are just synthetic casinos making wild option bets. And you're probably going to stop the video right now and just pause the video. I know some of you just going to pause it and be like, yeah, it is a casino. Don't ever touch it. Okay. However, my research of their legal filings for this proves this is completely wrong for the big D. Okay. Give big D a chance here. Okay. You might like the big D. All right. You might actually have some big D in your portfolio here. So what I did find out is they are a hybrid engine. Okay, so under normal circumstances, 80% of this fund physically holds SCHD. Yes, that is crazy, right? YieldMax doesn't typically hold physical, and it's underlying companies, right? So it is a physical backed hybrid engine, not a pure synthetic derivative that we're used to from YieldMax products. Okay, so hope I call your attention. Hope you didn't close the video out yet. All right, the moving target. All right, so it is aiming for a 2x SCHD base yield. Okay, and they're not paying monthly. I was wrong in the other video. I did say monthly. They have the quarterly hustle. They're paying quarterly. All right, so their strict mandate is to pay you exactly double whatever the SCHD ETF is paying out at any given time. But here's the catch: that target yield fluctuates constantly based on SCHD's actual performance, right? So they also pay this out quarterly, just like SCHD. A lot of people are pairing this with SCHD with the big D. All right, so which is totally different from weekly or monthly payouts you might expect. All right, so I was wrong on this part. All right, let's look at the boomer base here. Okay, there's a lot of boomer stuff, boomer holdings. Not a good thing, not a bad thing. It's just whatever your stance is, right? So the entire strategy sits on top of SCHD, which holds ultra safe cash flowing giants like Lockheed, Chevron, and Verizon, right? These boring stocks only have a historical volatility of 11 to 13%, right? So from an options trading perspective, this is a terrible, hostile, low premium environment. Okay, we don't want that. It's not good. There's no juice to squeeze here, right? High safety means low volatility, which mathematically means absolutely terrible options income, right? Because like I said in my previous little video and all other videos, whole point of our game is to sell fair, right? We want that fair. Right, the credit spread upgrade. So it looks like people are starting to realize that, hey, look, we got to start copying Neos and Amplified and Goldman, right? Because they know what they're doing. They're surviving in any type of environment here, right? So most yield ETFs just write naked cover calls to harvest maximum cash, which totally destroys your upside, right? The big D uses a cover call spread instead, right? Meaning they sell a call but simultaneously buy a higher one to protect against massive market rallies, okay? While this does save you from missing out entirely on huge bull runs, it actively eats their profits, okay? Buying that protective call does cost money, okay? Making that aggressive double yield target mathematically much harder to hit. Okay, so what is the secret loop behind this? Is the secret sauce? How is it going to survive, right? So let's unbundling, right? Because SCHD index is too boring to generate enough options premiums, right? The manager uses a clever loophole, right? Direct targeting. They unbundle the ETF and write options directly on individual constitutes stocks like Lockheed and ConocoPhillips, right? The gas company, I think. And then this leads to richer premiums, or in theory it does, right? Individual stocks bounce around more than a blended index, allowing them to squeeze out much richer option premiums. All right, let's look at the collateral buffer, because it's not a YieldMax product without one, right? So the cash parking here. The fund keeps up to 20% of its total asset parked in cash and short-term T-bills. Margin rules, right? This serves as a mandatory margin collateral required by clearinghouses to trade option safely. Risk-free yield, well, more importantly, it generates a risk-free interest yield sitting quietly on the sideline. So in my previous video, if the rates does go up, this is great. This is a good thing, right? They're getting paid more money to pay out your yield. All right, hitting the target, right? This tiny bit of extra collateral directly helps them hit that massive double distribution target. And if the rates pump it up to, the Fed pumps it up to 6%, 7%, 8%, all they have to do is just rotate. That's like, they're just paying you for T-bills at that point. You can do yourself, but yeah. All right, the hard math. Let's look at the 0.87 quarterly hustle. This is going to get a lot of people, because a lot of people don't think about this, right? This is the massive hurdle. What do I mean by that? Well, if SHG yields roughly a 3.5%, this fund has to magically engineer another 3.5% just from options, okay? So after subtracting a massive 1.01 expense ratio and trading costs, they need to clear roughly 0.875% every single quarter. Now, I already know, you guys, this sounds incredibly small, but in low volatility options world, it is a massive mathematical hurdle, okay? They are forced to take on hidden risks just to make the math work. Okay, the ugly truth here, okay? Here's the ugly truth of options math, right? High predictable dividends actually depress the price of call options. Why? Because SHG is literally a high dividend asset, right? The options, they said, will always command lower premiums. So to extract enough cash, managers are forced to write options dangerously close to the current stock price, right? This means they are aggressively capping your ability to capture real stock price growth. Now, of course, you're buying this not for the stock growth, of course. I'm just put it out there before you go, oh, I'm buying this for income. Yes, I just want to put this information out there. Okay, this can lead to the death spiral, right? So what happens when low volatility stops them from making enough cash, making enough options cash to pay you? Well, they're forced to distribute your own principal back to you, which is officially called destructive return of capital, right? So if this happens consistently, well, then your NAV erodes away permanently, right? A shrinking portfolio means they have to write options on fewer shares, creating a terrifying self-cannibalizing death loop here. Okay, let's do a stress test. This is, again, my opinion on the scenarios here. We're going to do a bull versus sideways, okay? So in a bull trap, what happens if the market rips up 20%, right? Their short call options will trigger and aggressively cap your upside gains, right? You will drastically underperform someone who just bought SCHD and just walked away and just sat on their hands, right? Let's look at the sideways jackpot, right? This is conversely, if the market trades completely flat, you hit an absolute jackpot here, right? The big D does very well. This is the ideal environment for the big D, where you keep all the option premiums with zero capital erosion. Okay, stress test, bears and shocks. Well, what happened in the bear market bleed, right? What happens if the market completely tanks? Well, you will absorb the massive underlying equity losses, and the tiny option premiums will barely buffer the drop. Okay, volatility shock. If a sudden panic spikes volatility, well, their existing options get crushed instantly, right? Their only hope of survival in a crash relies entirely on the market's the manager's ability to perfectly time new, highly lucrative option trades here. Okay, execution drag, right? Remember the expense ratio? Well, this is part of the execution drag, right? The fund suffers from extreme path dependency, meaning your returns depend entirely on what day the manager decides to trade. Okay, unlike passive ETF, they are constantly rolling contracts and crossing wide bid-ask spreads, right? This high frequency turnover rate generates severe execution friction in the background that you don't really see. So every single trade bleeds away a tiny piece of your premium and drags down your NAV. Okay, the micro cap problem, right? They have about $2.3 million assets under management. Of course, yes, it is new. It literally about a week old, week and a half, right? It is tiny and expensive, right? This is a tiny, very early stage fund with only around, give or take, 2.3, maybe 2.5, right, million dollars in assets under management and roughly 75,000 shares. Because it is so incredibly small, market makers force you to pay a massive 0.16 bid-ask spreads just to buy in, okay? And on top of this, again, low liquidity mixed trading, complex multi-leg options, much more expensive for the managers, right? If it doesn't get popular fast, there is very, very real risk the entire fund does get liquidated. Okay, the black box warning, right? Of course, guys, there is absolutely no fixed rule-based constraints governing how this fund operates, right? So I discovered they have given total control, blind discretion to Ziga Financial. Of course, almost all YieldMax, I think, products have done this to pick the strike price and expiration dates. So you guys have to understand this. You are placing entire faith in their proprietary volatility models and macroeconomic guesswork. So you look at their historical data and their performances. Well, what are their success rate? What are their failure rate, right? So if their models fail to predict the model accurately, your money will quite literally go up in smokes. Gone, right? So where does this fit though, right? I built this table to show you exactly where the big D sits at the market. Again, this is my take. So if you're placing it against a dividend ETF like SCHD, right? It's gonna, and you're placing it against a synthetic call, I'm going to say the target spread fits right in the middle, right? So a lot of people I'm starting to see pairing this up with SCHD. Hey, this could be a good, satellite for SCHD. Right? They both pay quarterly. Is pretty much, I guess, you're trying to play this as a SCHD on steroids. I don't know, but it fits right in the middle with its nice target spread here. Right? My brutal verdict before I end this: the big D will, not a lot of people can agree with me, will mathematically work, and I put that in quotes here, okay? But only if you accept the extra yield is being paid for directly with your future upside, all right? This is my truth on the big D, okay? The fund is not fundamentally flawed, but it does operate in an incredibly fragile environment, okay? The big D can go limp at any given time, and you have to worry about that, right? So who is this actually for, right? You should buy this if you are a strict income seeker betting on a perfectly flat sideways market. Okay, you should buy this if it makes sense as a small portfolio slice. If you're desperately prioritizing current cash flow over wealth preservation, you should buy this. Oh well, I'm sorry. You should avoid this if you're a long-term compounder or total return maximizer. Obviously, SHD is the option there, right? You should avoid this if you actually want the uncapped compounding growth of SHD high quality companies, right? Then you stay far away from this fund, right? The big D is not for you. Stick with little d. Right? That's my final takeaway, right? I've shown you the math, the loopholes, and the very real risk of NAV erosion, right? The big D is a fascinating structural experiment, but it is not a magical wealth building machine, okay? So that part in my last video, I still say this, I'm saying it again, right? It is a highly tactical tool, like I said in a previous video, right? That trades your tomorrow for a slightly better today, right? Do not buy it blindly, okay? Understand how far you can take the big D in your portfolio, okay? It might be a couple of inches, might be the whole way through. You just need to know how much you can take of it. Okay, if this was video was informational, creative, fun, you're new and you were just looking at YieldMax and you came across the video and you are gonna buy the big D, but now you're second guessing yourself because I made you second guess yourself. That is a good thing. That is always a good thing. All right, give me a subscribe, comment, like. Always appreciate you guys helping me out. And thanks for watching, guys. Stay tuned. Catch you guys on the next.